Ladies and gentlemen, my name is Leonard Spoto, and I'm one of the owners of Asset Exchange Company, a 1031 exchange accommodator. Now, this company was founded about 11 years ago by both myself and my business partner, Adam Skarsgård, who is a tax attorney. We've been facilitating exchanges, the two of us, for about 20 years, but we started this company 11 years ago. Our company does not sell real estate. We do not provide escrow or title insurance. The only thing that we do is facilitate 1031 exchanges. Now, we do thousands and thousands of exchanges every single year. We're a very large independent exchange accommodator. We are a full service exchange accommodator, so we do the standard delayed exchanges, we do reverse exchanges, and we do construction exchanges. All right, all accommodators do basically the same thing. All right, what we do is, number one, we hold money during the exchange process. Number two, we prepare all the legal documents that are required to properly document the transaction. And number three, and very importantly, we are going to make sure that you're in compliance with the Internal Revenue Code related to Section 1031. Now, although all companies in our space do the same thing, there are obviously different levels of service, experience, and professionalism. So when you're choosing an exchange company, you want to choose wisely. Now, my company, we've been doing this a very long time. As I mentioned, we have seen thousands and thousands of exchanges. There is not a scenario that you could propose to me that I haven't already seen. I am 100% certain about that. So you're going to benefit from our experience, you're going to benefit from our wisdom and the processes and procedures that we have in place. Now, a little bit about my company. We are a member of the Federation of Exchange Accommodators. We are also required by state law, which is a very good thing, to be insured and bonded. As I mentioned, my business partner is a tax attorney, so he is a member of the California Board of Accountancy as well as the state bar. Now, one of the unique things about my company, remember I said we all kind of do the same thing. Well, we actually provide one additional level of service for all of our clients. We do provide our clients free audit support if the exchange that we worked on with the client is audited by the IRS. Now, hopefully you do not need our free audit support. Hopefully when you do your 1031 exchange, you are never audited on the particular transaction. But if you are and you don't use our company, you're going to have to go out and hire a $500 an hour tax attorney to try and defend you. Now, I can guarantee you that unless the tax attorney works for a very large 1031 exchange company, they haven't seen as many 1031 exchange transactions as we have. This is just what we do every single day. So we're in a very good position to help our clients defend an IRS audit. What that means is we cannot represent you in tax court, but hopefully we will help you avoid going to tax court because we will help prepare a defense for you. And that includes citing private letter rulings as well as tax court opinions and tax court cases that help substantiate the position you took in your 1031 exchange. Now, everybody on this call hopefully knows that with a 1031 exchange, you can defer taxes on the sale of your investment property, right? This is the advanced class, so hopefully I'm not having to define what a 1031 exchange is. But for those of you who don't know, well, 1031 exchange allows you to defer taxes on the sale of your investment property. Now, there's a lot of rules that go into how to do that, and we're going to go over those today. Now, think of the 1031 exchange process similar to your 401k, right? You've got a 401k that allows you to invest, and there's specific tax advantages to doing so inside your 401k. But the government has rules on when you can touch the money, how you can get it out. You have to use a custodian, and the 1031 exchange process is very similar. Now, if you don't follow the rules when you're doing a 1031 and you get audited, the onus is upon you to prove to the government that you followed the rules. Now, if you cannot do that, you're going to have a problem. Hopefully, the only thing that happens to you if you have your 1031 exchange disqualified is that you have to pay taxes. Now, a more likely scenario would be that you pay taxes and interests and a possible penalty. Now, the most unwelcome response from the IRS is that you have your exchange disqualified, you have to pay taxes, penalties, and fines, and they throw you in jail for tax fraud. Now, this happens. Doesn't happen often, but there are situations where clients have gone to jail for tax fraud related to a 1031 exchange. Don't believe me? Take a look at your computer screen. Now, this was a press release from back in, 2013, where a realtor by the name of Cheryl Savage was sentenced to 14 months in prison for tax fraud related to her 1031 exchange. Let me tell you what happened. Cheryl decided to do an exchange. She wanted to sell an investment property, and she wanted to avoid paying taxes on $750,000 of gain. Now, Cheryl was a realtor. She knew that the only way to not pay taxes was to do an exchange. So she sold the property, set up a 1031 exchange account, and then went and bought a new replacement property. Now, the problem was that the replacement property that Cheryl bought was a primary residence. Cheryl bought a property with 1031 exchange funds and immediately moved into it. She then proceeded to falsify her tax returns to make it look like the property she was living in was a rental. You'd be surprised. People ask me about doing stuff like this all the time. And I tell them, listen, what you're asking me to do is against the law. It's tax fraud. I can't be party to that. And if you do it, you could end up in jail. You don't want to go to jail for tax fraud when you're doing an exchange. So very, very important, ladies and gentlemen, you got to follow the rules. And the government doesn't care if you just didn't know the rules. Ignorance is not a defense, right? So you got to make sure that if you're going to try to get these tax breaks, which are very generous, that you just do it correctly. If you don't, well, there's consequences. Now, worst case scenario here, you could serve jail time. You could visit Cheryl in prison. But most of our clients, if they have their exchange disqualified, they're going to pay taxes, penalties, and interest on those taxes. All right, I'd like to start off with this discussion because I try to scare you into paying attention, right? So hopefully I have your attention. Now, hopefully none of you are going to go to jail when you're doing your exchange, but I do want to let you know it is a possibility if you really screw up. All right. Now, let's look at a couple deals that were successful. My clients did, and they did not end up in jail. They actually deferred all of their taxes. I like to talk about these deals because they illustrate some interesting points about the 1031 exchange process. So let's take a look at the first building here, the Galaxie Office Park. This was a building that sold for $42 million. And it sold several years ago. And what was interesting about this particular transaction was these clients were pretty sophisticated people. They had a bunch of unsecured debt. They had LLCs on title. But what happened when these guys got into escrow was they called me up to set up the exchange account. And they asked me when they were doing the transaction if when the property sold and they paid off their debt, they were going to have about $30 million of cash come out of the property. And they asked me, hey, Leonard, when we get that $30 million, we want to invest the $30 million in the stock market until we find our replacement property to buy. Now, for those of you who have done exchanges before, you know the answer to this question. When you do an exchange, can you take the funds, the sale proceeds, and go invest those proceeds in the stock market? Absolutely not. When you do an exchange, rule number one, just the most basic thing you need to know is you cannot touch the money. right? If you touch the money, if you're in constructive receipt of the sale proceeds, you are paying taxes. One of the most important parts of the exchange process is you need to work with a neutral third party, that's me, to hold the funds until you go out and buy replacement property. So very, very important, ladies and gentlemen, if you plan on doing an exchange, you can't touch the money. Now, what happens if you closed escrow 2 weeks ago and you didn't set up an exchange account? Guess what? You can't do an exchange. The funds were released to you 2 weeks ago, and you call me up and say, well, geez, Leonard, I wanted to do an exchange. I didn't cash the check. It's just sitting in my pocket. Can I still do an exchange? No, absolutely not. All right, you got to get your exchange account set up before you close escrow. Anytime during the escrow process is fine. You can call me up the day you open up escrow or the day before you're set to close. I can coordinate with the escrow company to get everything in place. But if you've already closed, you are out of luck. At that point, you are a taxpayer. So very important, whether you're selling a $400,000 property or a $42 million property, get your paperwork lined up before you close. All right. So let's take a look at another building that we had the privilege to work on. This building here, the Sandy Springs apartment project in Atlanta, Georgia, was an interesting one. And it was interesting because there were actually 27 owners of the property. Now, it was a pretty big property, right? $26 million property. But what was interesting is that it was owned by a lot of people. And this brings up a very interesting point. When you do a 1031 exchange, I want you guys to remember this. When you do a 1031 exchange, the taxpayer who sells the property needs to be the taxpayer to buy replacement property to complete the exchange. Pretty simple, right? Now, most of the time, it's pretty simple to know who owns the property. You just pull up the title report, maybe mom and dad are on title, and they're going to sell, and they go out and buy. But we pulled up the title report, and there was 27 people. And guess what? That's okay. Provided each of those individuals are on title as what's called a tenant in common owner, and they are reporting the individual property on their tax returns, they're depreciating the property, taking all those depreciation schedules, reporting rental income on their tax returns, they are going to be able to do an exchange. Now, they can do the exchange together as a group. They can do it individually. Some people can cash out. Some people can exchange. You've got a lot of flexibility when you hold title as what's called a tenant in common owner with other individuals. You can do whatever you want individually. Now, the same is not true had these individuals decided to not own as tenant in common, but instead decided to form a company or a partnership. Now, we see that quite a lot with larger buildings that are owned by lots of people. They decide, well, geez, for liability protection, why don't we just own this property in an LLC? Right? Makes sense, right? You want to limit your liability. Well, the problem when you do that is you are creating a brand new taxpayer. The taxpayer who owns the property is no longer the individuals. It is one entity, the LLC. And that entity is its own taxpayer. And if the property is sold, who is selling it? Well, not a bunch of people. A corporation, a company. The LLC is selling the property, and as such, the LLC is the only entity that can enter into the 1031 exchange. Now, that is fine as long as all the members of the LLC want to go forward together. But what happens when you have a company formed and one of the members, just one, says, whoa, wait a minute. I don't want to go forward with you guys on the next deal. Give me my cash. I'm willing to pay taxes. I just want out of this group. Well, you've got a problem. All right? So for 1031 exchange purposes, ladies and gentlemen, it is very important how you hold title. Very often, the way title is held can screw up the transaction. I've had deals fall out of escrow because the client calls me and says, hey, I want to exchange. Okay, no problem. I pull up the title report and I notice, well, geez, you're not on title. You've got a partnership or a company that actually owns the property. And then we dig a little deeper, and there's 6 or 7 or 8 other people involved. So one of the things that you want to remember if you're a realtor or an investor doing an exchange is the taxpayer who sells is the taxpayer that needs to buy. If the LLC is the only taxpayer on title, that LLC is doing the exchange. Now, James asked me a good question. Well, is that the same for a trust? Well, the answer is, James, it depends. Trusts can be revocable or irrevocable. A revocable trust is disregarded for tax purposes, meaning it's not its own tax entity. So an irrevocable trust is the opposite. It is its own tax entity. So James, the answer to your question is it depends. I'd have to figure out what type of trust is on title. Now, 99% of the time, a trust is set up by mom and dad so that when they die, the government knows that the property goes to the kids. So 99% of the time, the trust is what's called revocable and disregarded. So most of the times, James, the trust is not going to be an issue. The trust can sell the property, the trust can buy replacement property, or the trustees can buy the replacement property. Now, Cornelia says, well, geez, can one person who gets cashed out use that cash to go out and do an exchange? No. If you got an LLC and the guy cashes out his membership unit of the LLC, he's not selling real estate, is he? What's he selling, Cornelius? He's selling a share of an LLC, and that's not exchangeable. So when you get involved in an LLC, you got to be careful. I'm actually involved in a couple right now. I've got a friend who goes out and buys $20 million apartment buildings, and he structures them as LLCs, and I just own a membership unit in the LLC. And the biggest problem with that is it's really hard to exchange out of it. So I'm planning on, when we sell this building, just paying taxes. Because chances are that all of the members of that LLC, and there's like 20 of them, they're not going to agree on how to go forward with an exchange. So know what type of investments you're getting into and whether or not you want to exchange out of them. If you want to exchange out of them, you need to take title in your name or your own company, right? Very important. Okay, good questions. And Ben, I see your question. I'm going to get to that eventually. Now, Galaxie Office Park, big $42 million deal. Sandy Springs, medium size or kind of big $26 million deal. Most of our exchanges aren't giant commercial deals, right? Most of the exchanges that happen nationwide are regular rental homes like this, all right? Husband and wife own these properties, pretty simple transactions. Client sells for $500,000 or maybe $1 million, goes out, trades into something bigger and better. So I don't want you to think that the only thing we work on are these big commercial deals. Now, they are a good component of our business, but most of the real estate that's sold nationwide are smaller, you know, under $1 million type of investments. All right, now why are people doing exchanges? Well, they are doing exchanges because they don't want to pay taxes, right? Pretty simple thought process there. You got a big tax bill to pay. How do I get out of paying it? Well, on investment property, the only way is to do the exchange. Now, did you know, ladies and gentlemen, that even with all this talk about tax cuts and everything, capital gains taxes stayed the same. So if you cash out of an investment property and you have to pay capital gains taxes, about 33% or 1/3 of your profit, your gain, goes to pay the government. I like to joke that on every piece of real estate I own, I have 3 partners. The first one is my wife, the second one is me, and the third one is the government. Because if I cash out, everybody needs to get paid. Now, of course, if we do the 1031 exchange, I can defer that payment, so I can avoid the government going and taking their share. So that's a big incentive. The other incentive is that, hey, if I'm doing an exchange, I get to keep that money working for me, and I can go out of a 2-unit building and maybe into a 4-unit building, right? I can use the money that would have gone to pay taxes to leverage into bigger and better properties. And a lot of our clients use this as a wealth building tool. In fact, Section 1031 of the Internal Revenue Code has been called the greatest wealth building tool available to investors. Very powerful way to build wealth. Now, some of our clients are already very wealthy, and they are using the 1031 exchange to achieve diversification in their portfolio, right? 2 ways to diversify. You can go into different geographies. You can go into different types of real estate. And some of my clients who are very wealthy own all of their assets in one area. Imagine if you owned all of your real estate in Napa, and a couple months ago when we had those fires, you lost everything. Well, that would be tragic, right? So a lot of our clients are thinking about that with all these wildfires that are rampaging through California, thinking, well, geez, maybe I should move some of my assets into a different area that's less prone to wildfires or hurricanes for that matter, right? I don't know where a safe place to go. Maybe Colorado, right? You go to the Texas, you've got hurricanes. You go to California, you've got wildfires. But a lot of our clients are using the 1031 exchange because they want to protect and preserve their wealth. And you do it, hopefully, with some diversification. Now, finally, last reason why people are doing 1031 exchange has to do with time. 2 things happen over time. Number 1, you get sick and tired of managing property. And number 2, your property becomes fully depreciated. 2 very good reasons to consider exchanging, right? You've got one property that is 3 hours away. The toilets always leak. You've got termites. You've got really bad tenants. You say, you know what? I'm sick of managing that property. Let's trade into something that's easier to manage. That's a good reason to exchange. Now, another good reason to exchange might be the fact that you are fully depreciated on your real estate and your tax benefit of depreciation is gone. So your CPA may advise you, hey, trade out of that property, exchange into something bigger and better that you can get new depreciation schedules on. Very good reasons to exchange. Now, I spent a little bit of time on this slide here because I know most of you are realtors, and realtors, these are good reasons to talk to your clients about listing and selling and doing the 1031 exchange. Very good conversation to have with your client who owns a lot of real estate. All right. Again, as I mentioned, the Tax Reform Act did nothing to lower the capital gains tax, so we are still paying the same taxes at the federal level. We've got a 15% capital gains tax. Unless you make over 400 or 450 married, then you get bumped up to 20. We have a depreciation recapture tax of 25%, and we have a tax to help fund Medicare, 3.8%. Now, state of California, where I am, we have, I think most of you are in California, we have a pretty steep tax bill to pay as well. We're looking at starting out at about 9.3%, but really we look at rates of about 10 to 12.5% when you're adding up your real estate sales as well. So plan, if you're cashing out of your real estate, as I mentioned, to pay about 33% total combined state and federal taxes if you decide to cash out and not exchange. Now, hopefully you'll exchange, right? I don't want to see you pay taxes if it doesn't make sense. Hopefully you don't pay those taxes. Hopefully you keep that money working for you. Now, a lot of people ask me, well, geez, Leonard, how do I calculate that number? How do I get my tax liability? Well, taxes are based on how much gain you have in the property. And gain is a simple function between your net sales price and your basis. Of course, that is going to beg the question, well, geez, how the heck do I figure out what my basis is? Well, your basis is what you paid for the property minus depreciation plus capital improvements. Well, what are those things? How do those formulas work? Well, let's do a quick example. All right, so let's assume I bought a property for $500,000. I've owned the property for a while, so I've depreciated $100,000 of the property. I had to put a new roof on a couple years ago, and that cost me $25 grand, and I am now in contract to sell the property for a net sales price of $1 million. That is those are the facts that I need to figure out your tax bill. So let's go through the numbers here. All right, so based on the facts, what we're going to do first is we're going to figure out first our basis. So we're going to take our purchase price, depreciation, we're going to subtract that, and we're going to add the capital improvements to get a basis of $425. Now, if we sell the property for anything above $425, we've got gain, right? We sold for $1 million, so $1 million minus our basis is our gain. Now, what's our tax bill? Well, pretty simple. What did I estimate your tax liability would be? Remember, about 33%. Let's see how close we get. So if we actually calculate all of the numbers, the CPA is going to do this for us, but if we actually calculate all those little taxes I talked about in the last couple slides, you get a tax bill that is very close to a third of your gain. So about $192,000 goes to pay taxes. Now, unless you're an accountant or a tax attorney or an advisor, I don't want you to crunch the actual numbers for your clients. What I want you to do is tell them about a third of your gain goes to pay taxes. And for a lot of clients, especially here in California, a third of their gain is going to be about $100,000, $200,000, $300,000. And when you're looking at tax bills in the hundreds of thousands of dollars, it makes very good sense to consider a 1031 exchange. Now, a quick question popped up from, I think it was Patricia. Patricia wants to know, how many years can I depreciate my property? Well, Patricia, it depends on what type of property you own. If it is a residential income property, those are depreciated over 27.5 years. If it is a commercial building, like a warehouse, an office building, then those are depreciated at 39 years if you take straight line depreciation. All right, so let's go ahead and move on here. There are two tax laws that everybody on this call absolutely needs to understand. The first is what I specialize in, Section 1031 of the Internal Revenue Code, all right, and that is tax deferral for your investment or business properties. All right, so Section 1031 of the tax code is one thing that everybody needs to at least have a basic understanding of. The other one is Section 121 of the Internal Revenue Code. And luckily, with the tax reform bill that was just passed, luckily, our industry groups lobbied very hard to keep this as it is. There was a proposal, ladies and gentlemen, to change the homeowner's exemption to 5 out of 8 years, meaning that you have to have lived in your home for 5 out of 8 years in order to get these exemptions that you all know about. Okay, luckily that did not go through. Luckily, the homeowner's exemption is still scheduled 2 out of 5 years. So let's talk about that. The homeowner's exemption states that if you live in your primary residence for 2 of the past 5 years, when you sell that property, you can avoid paying taxes on the first $250,000 of gain if you're single, the first $500,000 of gain if you're married. So, homeowner's exemption, Section 121 of the Internal Revenue Code, tax deferral with our investment property sales, Section 1031. These two tax laws will come up in almost every transaction you guys work on, right? Most people sell either homes or investment properties. Now, can you imagine a property that you might work on getting sold that would not involve either this or this? How about a second home? Does anyone have a property that they own in Palm Springs? You don't rent it out, you just use it during the winter time? Well, ladies and gentlemen, a second home isn't going to qualify for 1031 or 121. You didn't rent it out, you didn't live in it, so you're not getting any tax break. People ask me all the time, well, geez, how do I get a tax break on my second home? Well, you need to move into it or you need to rent it out. If you don't do one of those two things, there's no tax break available to you. Now, what about a second home that I rent out on occasion? Well, you may qualify for 1031 on a second home that has some rental activity, but it depends. It depends on how much you rent it and how much you use it. So if you do have a second home with some limited rental activity, pick up the phone, give me a call. We're going to run through the facts and circumstances, and we're going to see if that will qualify for 1031. All right, now take a look at these two, and I know I've got a bunch of questions that have popped up. We'll get to those, guys. Don't think I'm ignoring you. We've got two tax laws here on the board, right? I'm going to ask you real quick, in your mind, I want you to tell me which one's better. How many of you said this one? Section 121 is better because what happens when you take your homeowner's exemption is you avoid paying taxes. There are no stipulations. You don't have to go out and reinvest. You just sell your home. You qualify for this tax break. $500,000 of gain if you're married is completely tax-free. Now, this over here isn't bad, but what we do with our 1031 exchange is we defer paying taxes. Now, what is a deferral, ladies and gentlemen? A deferral is simply you're putting off your tax bill into the future. And with 1031 exchanges, you are deferring until you eventually cash out. So let me give you an example of how the deferral process works. What happens is you're going to sell a 2-unit and you'll exchange into a 4-unit. No taxes are paid. You sell the 4-unit, you exchange into a 10-unit. Again, no taxes are paid. You sell the 10-unit, you get into a big 20-unit apartment building. Okay, you've done a series of transactions and all of them have been tax deferred, so you've never paid taxes. The problem is, if and when you cash out of this 20-unit apartment building, and if you decide to take the money, guess what? You pay the taxes. You pay the taxes on the profits on the 20-unit, the 10-unit, the 4-unit, and the original 2-unit investment. So what's happening with the 1031 exchange process, if you are a successful investor, which all of you will be, you are going to build a snowball of taxes that gets bigger and bigger and bigger with every transaction you do. And down at the end, when you go and sell your final deal, you're going to have to pay $2 million in taxes if you cash out. Not the worst thing in the world because you've been very successful, but raise your hand if you look forward to paying $2 million to the government. I don't see any hands, and I'm looking very hard. So what do? Well, there is a strategy in real estate that we call the 3 Ds of investing. What I want you to do is write this down so you don't forget it. The 3 Ds of investing are defer, defer, die. If you pass away while you own real estate, what happens to that property? Well, it's going to go to your heirs, most likely your children. The children will inherit the property at what is called a step up in basis. The capital gains liability, the capital gains tax liability goes away. It dies when you die. Okay? The basis, remember, we did some accounting talk a few slides ago. We talked about what basis was. The basis steps up to fair market value. If your property is worth $5 million and you pass away, the basis, which was very low for you, steps up to $5 million for your heirs. The kids inherit the property. The day after your funeral, they put it on the market. They sell it 2 weeks later and put all of that cash in their pocket, completely tax-free. Now, some of you are thinking that's got to be too good to be true. Well, it's very good, and it's true. And the other thing is that the government just increased the estate tax limits. So literally 99.9% of the United States population will pass away, and all of their kids will inherit property and pay no capital gains tax and no estate tax. The estate tax limit, for those of you who aren't following this tax reform stuff, it has been stepped up to $11 million per individual, $22 million for a couple, meaning that I could pass $11 million of real estate to my daughter and my son when I pass away, when I bite the bucket, or when I kick the bucket, and they will have no death tax or estate tax. All right. So Patricia says, well, geez, how long do I have to sell, or my kid have to sell, in order to take advantage of the step up in basis? Well, what happens, Patricia, is that the property will pass to the kids at a stepped up basis, right? So if I have a $5 million property, that basis is now $5 million. So the kids could sell it that same year. They could sell it 2 years later. They will only be taxed if the property sells for more than $5 million. So if they sell it 10 years later, but they still sell it at $5 million, well, there's no tax. If they sell it 1 year later, but they sell it for $6 million, well, they're going to be taxed on that new gain that they earned during their holding period. Does that make sense? These are very important concepts. They are fantastic ways for you to pass on wealth to future generations, and all of your wealth. All right, let's get into the nitty-gritty. A lot of your questions that have popped up about 1031, holding period, and whatnot, we're going to answer here. So let's go into the requirements for successful 1031 exchanges, because hopefully I've convinced all of you that instead of cashing out of your properties, you're going to exchange them. So when you do your exchanges, here's what you need to do. Number one, make sure your property's qualified. Have to sell investment, buy investment properties. Or business, right? Business properties qualify too. What does not qualify for 1031 exchange? Well, primary residence obviously don't qualify. The other thing that doesn't qualify is inventory. You can never exchange inventory. Well, how can real estate be inventory? Well, real estate is inventory if you buy it with a specific intention to sell. So quick flips are inventory. Development deals are inventory. If you're a developer or a flipper, you are paying taxes. Properties involved in an exchange also need to be like kind. Now, this can be confusing for people. Some people say, well, geez, if I sold a 2-unit building, do I have to go buy another 2-unit building? No. You've got the flexibility to sell and buy any type of real estate as long as it is investment property or business use property. So you sell an apartment building, you buy land. You sell land, you buy a rental home. You sell the rental home, you buy an office building. That is fine. You can buy anywhere in the United States, in any state. So you can sell in California, you can buy in Texas. What you cannot do is you cannot buy outside of the country. You cannot sell in California and buy in Mexico or Canada or China. That does not work. So rule number one, make sure your properties qualify. Now, someone asked me a little bit ago, how long do I have to hold the property? I think it was Cindy. Well, the property should be held and seasoned as an investment for 2 years. Some very aggressive tax advisors will tell you, hey, you can hold it for 1 year, but I will tell you here in California, the Franchise Tax Board likes to see 2 years of rental activity reported on your tax filings in order for your property to qualify. So if you want to be safe, hold the property for 2 years. Rule number two, when you do your 1031 exchange, if you don't want to pay taxes, I need you to remember 2 things. Number one, reinvest all of the cash. And number 2, purchase property equal or greater in value. Now, this is simple. If you sell a building for $1 million, net sales price after commission and closing costs, what do you need to buy? You need to buy replacement property for $1 million or more. All of the cash, all of the sale proceeds coming out of the property go to the accommodator and then are used as a down payment to buy the replacement property. You can either get a loan for the difference or contribute additional cash. All right, that's important. Some people think you have to get a loan for the difference. No, you don't. Most people do, but if you have a bunch of cash sitting in your piggy bank that you want to use instead of getting a loan, that's fine. What is most important, again, is that you are buying property equal or greater in value and using all of the cash as a down payment. Any cash that you put in your pocket from the sale is taxable. Now, that's not the end of the world. You can do what is called a partial exchange. You can sell a building for $1 million and you can buy something for $950 and just pay taxes on the difference. That's okay. So if you don't want to pay taxes, though, what do you have to do? Well, I've got to spend all my money and buy equal or greater. Now, you can sell one, you can buy one. You can do multi-property exchanges as well. You could sell one, you could buy 3, as long as everything you buy is equal or greater. So if you sell one for $1 million and you buy 3, and each of those 3 cost $350, hey, you're fine. You're good to go. All right, rule number one, Rule number one, make sure your properties qualify. Rule number 2, purchase property equal or greater in value and reinvest all of your cash. So Ben wants me to clear this up. He said, so if I sell for $1 million and pay off my loan and then my closing costs, what do I have to buy for? $1 million minus your closing costs. All right, you don't get to deduct your loan from your exchange requirement. So don't get confused. You sell for $1 million after commission and closing costs. You need to buy for $1 million. You pay off your loan of $700,000. You've got $300,000 in cash. That is your down payment to buy your $1 million property. All right, people get confused on this all the time. All right, let's move on. This is pretty simple, ladies and gentlemen. Rule number 3, you have 180 days to complete your exchange, and you have 45 days to identify what you're thinking of buying. You're going to close escrow. That is the beginning of your time frame. You then have 180 calendar days, about 6 months, to go out and purchase and close on replacement property. And very important, you need to identify what you're thinking about buying on day 45. How do you do that? Well, the government says on day 45, when you nominate or indicate what you're thinking about buying, you have 2 options for doing so. You can use the 3-property rule. So you sell your building for $1 million and you nominate 1, 2, or 3 pieces of property, but only 3. They can be of any value anywhere in the country. But when you use the 3 property rule, you only get 3 potential replacement properties to nominate on day 45. Now, remember this, ladies and gentlemen, you do not have to nominate or indicate what you're thinking about buying until day 45. So in the first 45 days, it is perfectly legitimate to go out and make offers on 200 different properties if you want. Hopefully you get into contract on one of those before day 45. If not, on day 45, you're going to submit an identification letter stating your top 3 choices. Now, once you submit that letter, you cannot change it. After day 45, it can't be changed. If you submit it early, you can always revoke it, but after day 45, you cannot make any changes. So once you submit your list of 3 on day 45, property number 1, if it burns down on day 46, you can't replace it. Property number 2 gets sold to someone else on day 47. It cannot be replaced. You now have 1 remaining property on your list that you need to purchase to complete your exchange. If you cannot do so, you fail your exchange. Not the end of the world, ladies and gentlemen. Pay your taxes, be done. We have clients who ask sometimes, and usually it's not the client, usually it's the realtor who says, well, geez, can't we just falsify our ID letter and submit it and backdate it? Well, yeah, you could do so if you want to go to jail for tax fraud, which people have done, as I've mentioned at the beginning of the presentation. So do us a favor, do your homework, figure out what you want to buy early in the process, get into contract within the first couple weeks on your replacement property, complete your exchange within the first 30, 40 days. That's how most of our clients do it in today's market. They're not waiting until day 40 to go out and start looking. Once their property is up for sale, they know in this market it's going to sell quickly, so they are looking very actively for suitable replacement property, writing offers, and getting their replacement properties lined up. So day 45 is crucial. You guys need to know. We will provide you, Bruno, with a specific identification letter that you will fill out and return to us. You will indicate you're either using the 3 property rule, or if you want to identify more than 3 properties, what you're going to do is nominate or fill out your form using the 200% rule. So 2 ways to fill out your ID letter: any 3 properties of any value, or as many properties as you want, but a limit on the value. So using the 200% rule, there is no limit on the number of properties. There's a limit on the value. The value of all the real estate you identify cannot exceed 200% of what you sold. So, for example, you sell for $1 million, you have a $2 million limit on property. You sell for $4 million, you have an $8 million limit on properties identified. Now, who makes up these rules and why is it 200%? Don't ask me. It was probably some intern for some congressman from Iowa. Who knows, right? But the rules are the rules. You need to know them to qualify for this tax break. So let's follow them and you won't have any problems. All right, I'm going to summarize here and then I'm going to start getting to some of your questions because they've kind of backed up on me here. In summary, successful 1031 exchanges, 4 things you need to remember. Number 1, make sure your property is qualified. Number 2, reinvest all of your cash and purchase property equal or greater in value. Number 3, you have 180 days to complete your exchange. And number 4, what do you need to do on day 45? Identify. Now, all you as an investor or realtor need to remember is these four things. Now, there's a lot of nuances that I'm going to be involved with and my staff is going to be involved with, like the vesting, and is the property owned in an LLC, and was it a vacation rental, and if so, how much time did you use it versus how much time did you rent it, right? Don't worry about all that stuff. When all those weird things come up, you're just going to call me, and we're going to figure the weird things out for you. What I want you to remember are these four guidelines and my phone number. All right. One other thing I want to go over, and sorry, we're running out of time. I'm going to skip through these slides here. A couple other things I want you to remember is most of our exchanges are done where the client sells a property and then buys. On occasion, however, the client will do the opposite. They will buy first, and then within 180 days, sell. That is called a reverse 1031 exchange. Now, I'm going to caution you. These are not fun. They're more expensive, and lenders hate them. So you are not going to do a reverse exchange if you need financing, unless you have a very flexible bank. Most of the people who do reverse exchanges are paying all cash for the property that they want to buy first. And when they go and buy it, they don't even get to own it. All right? My company becomes the buyer, and my company will own the property until you get yours sold. All right, so a reverse exchange, yeah, you can go out and buy first and then sell, but it's really not that easy. What happens is I become the straw buyer for you, I lease the property back to you, and then once you actually get yours sold within 180 days, then you get to own the new one. All right, these people ask about these all the time, and for every 100 questions I get about these, maybe one person actually does them. They're more expensive, lenders hate them, and because of that, you usually have to have an all-cash buyer. And remember, you haven't even sold your building yet. So you got to have a client who's got a big piggy bank in order to do a reverse exchange. Now, last type of exchange that I want to mention, these are actually kind of neat. You can do what is called a construction exchange, where you use 1031 exchange dollars to build or improve a property. Well, how does that work? Well, you're going to sell your building, maybe your rental home, and the money comes to the accommodator. You tell me, hey, Leonard, I found some land. I want to buy it, and then I want to use the rest of the money in my exchange account to build. Perfect. You can do that. The problem is, back here when you buy the land, you don't get to own it until the construction is done. So who becomes the buyer of the land for you? I do. I become the straw buyer of the land. You use the money that's left in the exchange account to do those improvements. Once the improvements are done, you've got your shiny new building. I will transfer ownership of that new shiny building to you. That's called a build-to-suit or a construction improvement exchange. All right, what I'm going to do now is I'm going to scroll through all of your questions because I know there's a lot of them. But before I do that, I do want to put my phone number and my email address on the board because I know that some of you are going to have additional questions and want to go into a little bit more detail. But my buddy Ben here is on the phone on the question board quite a bit, so Ben's got a lot of questions. Ben first wants to know, can you use exchange funds into a trust used by a private money lender for investment purposes? Well, what do you guys think? Okay, remember rule number one, properties must qualify. So if I want to use my 1031 exchange dollars to buy something, it has to be real estate. So no, Ben, unfortunately, you got to buy property. You can't go into a fund that buys notes. You can't go into a fund that buys real estate. You got to actually buy the real estate yourself. Patricia asked about depreciation. We went over that. Remember, depreciation schedules 27.5 years for residential and how many years for commercial? 39. Deborah says, my client holds title on a property in the estate of her deceased husband with her as the one in charge of the estate. She's already bought 2 other properties under this title and wants to sell the 10 unit and do a 1031. Any concerns? No, I'm not concerned at all. Because what happens is, if it was done properly, I'm guessing there is a trust that owns the property. Her husband passed and she's the other trustee of the trust, so she's going to be doing the exchange. Now, Deborah, my concern is that you need to make sure that's the case. So what I'd want to see, if you can email me the title report for the property, we can take a look on it and make sure all of the I's are dotted and the T's are crossed. Cornelius, he says, what if you get married while you own a property? Well, in California, you're going to get married and you're going to likely want to add your spouse to title, or I recommend you set up a trust and you make you and your wife the trustees. Okay, but yeah, not a problem if you get married while you own the property. What happens if you don't change title, Cornelius, and you keep the property just in your name? If you do an exchange, you want to do it just in your name. Ben says, how soon after the 5-year mark passes must one sell to appreciate the 121? Well, remember, Benjamin, you gotta live in the home for 2 of the past 5 years. So what happens is you can live in it for 2, and then if you move out for longer than 3 years, your homeowner's exemption expires. James says, what if a married couple owned a house and the husband just died? Can the wife get the 500 or only 250? Good question, James. James, the answer to that is, if the spouse, the surviving spouse, sells the property in the year that the husband died, then they get the full 500. But if they wait, then they're going to have only the 250. But remember, here in California, when your spouse dies, you get a step up in basis. So really, probably a moot point anyway. So Benjamin wants to know, what are the minimum days, the number of days, the minimum number of days we have to rent the property out for it to be considered a rental? Very good question. And it's a very small number, 14. So as long as you have 14 days of rental activity on the property for the 2 years prior to the exchange, it will qualify. However, if you use the property personally for more than 14 days or 10% of the amount of time it was rented, it is ineligible. Okay, this is why I get paid the big bucks, right? Who the heck knows this stuff, and why would you know it? Okay, so I'm going to tell you again. So Benjamin, minimum number of days of rental activity, 14. So that's all you need in 2 years prior to the sale. However, your property will be disqualified from exchange if you've used it more than 14 days or more than 10% of the amount of time it was rented, whichever's more. Did I confuse you? I've got an article that discusses that. If you have vacation properties with limited rental activity on it, what I want you to do is shoot me an email and I can send you the article in writing. So that's kind of a weird nuance to the tax law. It was actually set forth in a private letter ruling in 2008. All right. Benjamin, lots of questions. Any time limits on buying, selling exchanges every 2 years? Yeah, we have clients who do 20 exchanges in 1 year. So there's no limitation on the number of exchanges. You just need to make sure your properties have been seasoned long enough to qualify. Joe says, what about a property used for Airbnb? Absolutely, Joe. That can work, and you just need to get the minimum rental period and limited personal use that we just mentioned with Benjamin's question. Joe says, what is a Delaware statutory trust and can you exchange into it? Ladies and gentlemen, a Delaware statutory trust DST is a vehicle to own real estate with a bunch of other people. Now, typically, a Delaware statutory trust is used to buy a 20 or a 50 or $100 million property and own that property with a bunch of other investors. Now, the government gave a private letter ruling that these do qualify for 1031. They are sold by brokers who have securities licenses because the government deems them securities. If you would like more information about these, let me know. I do not sell them. I do not get referral fees from the people who sell them, but they are decent options for people and can be great options for people who just maybe don't want to manage property anymore. Because what you buy into is a fractional ownership of a very big building that's professionally managed by a big real estate company. So DST. Good question, Joe. So Patrick wants to know, in addition to the down payment, can my 1031 dollars be used towards the closing costs for the new property? Absolutely. Can they be used for impounds to the new property? No. You can only use your 1031 exchange dollars to pay for transactional related costs for the property, meaning escrow, title, transfer tax, anything that is related specifically to the purchase or sale of the property, and nothing related to the loan or the reserve account. Okay, almost done. Let's see. Can I exchange out of a DST? Absolutely. You can go into a DST, and then when the DST is eventually sold, you can go out of it. And then Cornelius, we're going to end with your question. Can you combine multiple properties into one exchange? Absolutely. You could sell 3, and you can use the proceeds from the 3 to buy one big one. Absolutely. All right, ladies and gentlemen, that's it. I'm out of breath. We're going to go ahead and wrap up. If you have any more questions, do not call me right away because I'm going to go get a big glass of water. Shoot me an email. And if you want to chat, call me this afternoon. One thing that I forgot to tell you, and this is the most important thing, okay? So hopefully no one's left and hopefully everybody's listening. I want to be your exchange accommodator, all right? Please do not use another company, okay? Give me your commitment that you'll give us a shot on your next deal. We'd love to work with you. We've got an amazing team here. We've been doing this forever, and hopefully I've given you a good enough impression of the knowledge we have and the services we can provide to give us an opportunity to work with you. Have a great rest of your afternoon, everybody. Oh, question, what are our fees? I will answer that. So we charge $750 when you sell and then $200 when you buy. That's about the industry norm. We're generally about $100 to $200 less than some companies. You'll see most companies in the industry are priced at about $1,000 for the sale of one and the purchase of one. Fees are paid out of escrow as a tax-deductible expense of the sale. All right, you can tell I'm losing my voice, so I'm going to go ahead and wrap up. Have a fantastic afternoon, everybody, and look forward to doing business with you all in the future. Take care.